All right. Here we are, ready to rock and roll. Markets going to close in 1 hour. So here we are, beginning of Power Hour, and we're going to talk a little bit about small accounts, day trading, and risk and money management today. Now, yesterday I had a meeting with one of our students from the university, and they are getting into day trading, and they've started and they've been practicing, and they went into the real money account. I'm not going to mention names, but this is a pretty typical, pretty normal, pretty almost exactly right straight out of the manual if I were to write a manual about students getting started or individuals getting started trading. What happens is you get all excited, you get the software, you get the tools, you get the strategies, you'll read the books, you do everything, and then you start trading um, on the demo account, and you start doing the things that I show you on the YouTubes, and then you get excited, you're making all kinds of money, and then you decide it's time to go real money, and you pull the trigger, you go into real money, and you start trading real money, and you'll lose a bunch of money. So then you stop trading in real money, and then you start trading in the demo account. You start trading in the demo account, and then you're too scared to ever go back to real money again. Then you become a professional demo trader. Now, I'm not saying that this individual who I talked to has done that. I'm just saying that's the traditional path that most people take. So this individual is going down that path, did all the things, traded the demo account, went live, started to lose money, did the right thing, contacted me and said, what am I doing wrong? What do I need to do? And I said, okay, we need to go back to some of the basics. All right. First of all, you need to trade in the demo account the same way you trade real money, or you need to trade real money the same way you're trading in the demo account. And so the problem is that most people trade in the demo account wild and crazy, like I do on YouTube. Go in there and we play all the time. Oh, here's a signal. Oh, there's an A signal. Oh, there's a B signal. There's a C signal. There's a D signal. There's an F signal. And we take them all, right? And so a lot of traders come in and they think, well, that's the way you're supposed to trade. That's the way Land's doing it. He's doing it like that on YouTube. And he always ends up making money on the YouTube. So I guess that's how you trade. That's not how you trade. You have to remember that I'm here teaching you, all right, the strategies. I'm teaching you how to execute trades. I'm teaching you the software. And I'm not in here teaching you how risk and money management. And that's the problem, because I've only got 1 hour. And risk and money management, I talk about it a lot, but we don't demonstrate it, because it's hard to demonstrate risk and money management, because that means that you sit on your hands for 3 hours in a row sometimes before you take a trade. And then you take one trade and then you sit on your hands for 2 hours waiting to take another trade. That's risk money management. There's not always an A setup opportunity, but when I'm here, I've only got 1 hour to show you everything I can show you about the software, and it ends up being a little bit more what I call financial entertainment. All right, you guys come here, you want to see me trade with the software, you want to see me make money, you want to see me take the trades, Land, take all the arrows, get in there, fight, win. And so that's what we do. But that's not how you really trade. All right. When you really trade, you have to be very conscientious about what's going on in the markets. You have to have your indicators tuned in to be just how the market's moving. You have to kind of understand and know what's happening in the markets. You have to have a little bit of backside look at the market. You have to look at where the high points are, the low points are. We always want to come in and we want to make sure that we know where our support levels are, our resistance levels are from historical price levels, because these are spots where markets will have a tendency to come back and touch back and forth. All right. So we need to be able to be a little bit more conscientious and not just come in here and blast through trades all the time. And the reason we don't trade like that is because it doesn't make sense to trade like that. You want to just take 1 or 2 good trades. We oftentimes call it three strikes, you're out, right? You play like baseball. So you get 3 trades and then you're out. But then the problem with trading in the demo account, like you do in the real money account, is that if you do it that way, you don't get very much training. I mean, you get training and practicing on not trading, on only taking A setups. But you can't get practice using the tools and getting familiar with how things work and all that kind of stuff. You know, we talk about all of this risk management. We talk about all this setup stuff. We talk about counting and measuring, looking for areas of support and resistance and trend lines and, you know, all that kind of stuff. We pay a lot of attention to that. But oftentimes when I come in here and I do these educational classes, I'm just coming in here and, you know, just showing you how tools work and how to set up different um, different order tools and that kind of stuff. And so I skip over a lot of the preliminary stuff because I've done the preliminary stuff in previous classes, and I don't want to have to cover all the preliminary stuff every single time we trade, because if I do, we never get to the stuff that I want to teach you that day, because I've only got 1 hour. So really coming and trading here is not just a one-off thing. You can't just come and say, well, I'm going to go join Land Turner's class one time and he'll show me how to trade, and then I'll be rich, rich, rich beyond my wildest dreams, and I'll know everything there is to know about trading. It doesn't work that way. I know some of you guys have been in here for 3, 4, 5, 6 months, and you're still learning something new every time we go through these classes. And I hope that you realize that I have little tiny snippets of what you're supposed to do in the market every time we come here, and that this isn't, when we come in here this last hour of the day, you know, the goal is to do a little bit of, you know, I have to admit, it's to do a little bit of entertainment here on YouTube, right? So we kind of do a lot of crazy stuff. We take every signal, whether it's a good signal or not, whether it's an A setup, a B setup, or whatever. We just take them all, and we do that so we can have a little action. Because if I sat here for 45 minutes and didn't take a trade because I didn't see an A setup, you guys would leave, right? You came here to watch me trade. You didn't come here to watch me watch the market do nothing. But that's what the market does most of the time. Most of the time, markets don't do anything, and there's not really very many trading opportunities. Because when we trade, we want to catch a trend, especially if you're in a mini account. And so that's, you know, why I had the little marquee up here, is because the class title today is, right, is Small Account Challenge. All right. So a lot of people, when they get started trading, they don't have a lot of money to start with, you know, maybe a couple grand. And that's what they want to start with. Well, when you start with a small account like that, you need to start with the micros. All right. Now we're in the futures market, so there is no pattern day trading rule. There are no pattern day trading rules. So you can trade here in the futures market and not have to worry about the account size. They let you start trading with a $2,000 account. The stock market, they don't. You can't day trade with a $2,000 account because you have pattern day trading rules. You have to have a $25,000 account. So when you come over here, you can trade in the futures market. And of course, that just takes a little bit different software. For those of you who are not aware of the futures market, it trades out of Chicago, right? And the New York Stock Exchange, it's out of New York, of course. And so they're two different exchanges. So out of New York, you trade the stock market, what we consider to be, you know, the traditional stocks like Microsoft and Amazon, Netflix, Google, the things you're familiar with. And over in the futures market out of Chicago, we trade something totally different. We can trade stock indexes, which is what we're looking at right now. And when we like to day trade and do that kind of stuff, we like to day trade on these markets because they move fast. And we like fast moving markets because you can make money fast. Of course, wherever you can make money fast, you can also lose money fast. So our strategy has to be very specific on how we trade these markets, because we don't want to get our wheels ripped off. So my strategy is, you know, you take the A signal. Once you get in, if it doesn't immediately move in your favor, you just get right back out, because you don't want to sit through these long drawdowns thing. Oh, it'll come back, because these markets are highly leveraged. So it doesn't take a lot of money to make a large amount of money. Like in the stock market, it takes a lot of money to make a small profit. In the futures market, it takes a small amount of money to make a large profit, because we got a tremendous amount of leverage over here. All right. So for example, just to give you a quick example, with a $1,000 investment, if you'd have taken that little arrow right there to where it's at the end, that's $280. And those are 1 minute charts. So that's 1, 2, 3, 4, 5, 6, 7. So you'd have made, in 7 minutes, you'd have made $280 with a, well, this is probably a little bit bigger than 1,000. It's probably, it's $1,800. So with $2,000 of an investment, you would have made $280 in 7 minutes. That's crazy money. All right. That's crazy. That's absolutely crazy money. So there's a lot of money to be made over here. Now that's in what we call the mini account. Now you can go down to the micro. All right. So there's a micro account, and you can see it's the same chart, basically the same chart, and it's 10 times smaller. All right. So we go, this is the mini. I just got them scaled a little bit different here. So, but you can see it's the same chart. Bring the scaling in, try to get the scaling the same. So you can see it's the same chart. If we go over here from this side, from entry here to here, you'd have made $28. Of course, your investment wouldn't have been $2,000, it'd have been $170. So you put up $170, you make 28 bucks. You say, well, that's pretty cool. I like that. I'm going to trade these micro minis. Okay, do that. Trade the micros. It only take, you can open an account with $2,000 and trade the micros, and you can make this kind of money, 28 bucks in 7 minutes. So you say, well, I'll stay in longer. Yeah, you got to stay in longer when you're trading the micros to make as much money as you would if you know, how far would the market have to move to make the $280 over here that you made over there. Well, you know, 280 bucks clear up here, but that's only with a $200 $170 investment. So if you come over here, if you put in the same $1,800, well, you'd only have to move the same distance because you're putting in 10 contracts over here on the micros as opposed to 1 contract over here on the mini. It's the same market, it's just different leverage. And you're like, well, that gives me a whole bunch more options. I can come over here and trade on the micro, and I can trade 3 contracts or 4 contracts or 5 contracts instead of 10. That's true. There's only one caveat with that. You have commissions you have to pay, and the commissions are not 10 times smaller in the micros as they are in the minis. They'd be nice if they were, but they're not. So now your cost of doing business goes up, and now they're smaller. The commissions are less in the micros than they are in the minis, but they're not 10 times smaller. All right. So you have to cover those costs. And so when you start trading 3 and 4 and 5 contracts over in the minis, you probably at that point should probably be over in the micros. You should probably be over in the minis because you're just getting eaten alive by commissions. Now, nothing says you have to trade on a 1-minute chart. Lots of people trade on the 15-minute chart in the micro market. So you come in here and turn on a 15-minute chart, and you can see that we got the micros. I'll turn on Fibonacci. I like the Fibonacci smoothing component, and you can see that you can just trade the 15-minute charts, and then from here to here, well, that's a $170 investment, and you'd made $393. There's nothing wrong with that. You can definitely do that, right? And then your $383 is going to easily cover the commissions without even a hesitation. The only problem with that is, and it's not a big problem, but it is the issue, you know, if you're day trading, that amount of time, that was 6 hours. That was 6 hours, not 7 minutes. So it's all relative, right? You can do what you want. You can trade how you want. It's just how long do you want to wait? And if you're going to be in a smaller market, you might have to wait more time to make the same amount of money. So for example, right there, that little bit of a move right in there, I don't know if you'd made, you know, you got in right when the arrows crossed and got out right when the arrows crossed. That was $62, but it took 4 hours to make $62 on $172. But the percent gain on that is incredible. Say it's $200, you got $62. That's like almost 30% return on your money in 4 hours. Go down to Cash Valley Bank and tell them you want 30% return on your money. How long are you gonna have to wait? 5, 10, 15, 20, 25, 30, 35, 40, 30, 5, 10, 15, 20, 25, 30. You're gonna have to wait 6 years. All right, to get 30% return on your money. So it's all relative. It's all relative. Right? It's all that crazy uncle. He's your crazy uncle relative. All right. So now you say, well, I don't want to go down. I don't want to do that. I want to stay down here on a smaller time frame. Okay, we'll go to a 5-minute chart then, or go to a 2-minute chart. All right. You get different time frames. You can do what you want. It's just going to take different amounts of time to wait for your patterns, your setups, and your money to play through. So this is a 2-minute chart, and this is a micro. All right. This is still a micro account. So if we take our 2-minute chart, and we go from this entry to this exit right there. Now there's a couple in there. We might have probably got stopped out right here, but we're just going to go from arrow to arrow. That was 80 bucks, $79. How long? How long did it take? Well, you take your little count bar in here, and from here to here, that was an hour and 40 minutes. All right, an hour and 40 minutes to make $79 on $170 investment going on a 2-minute chart from arrow to arrow. So you're like, well, I want to make money more faster, Land, more faster. All right. Well, then you jump up to the minis and you come into the minis, and we'll go to a 1 minute chart on the minis, or you go to a 2 minute chart on the minis. Right. So let's say just right here from where this market's taken off, if we'd have just taken that arrow right when we got in and started talking from here to here in this market, that was a $480 move so far. We're off just a little bit, so consider $450 bucks. $450 with a $1,700 investment in, now this is a 2 minute chart, so this is 2, 4, 6, 8, 10, 12, 14, 16, so in 16 minutes. So we've been sitting here talking for about 16 minutes. And that market came up and you'd have made $480 in 16 minutes right there. And it's coming up and testing this previous high right here. You got to take a look at that. So you can have your little, it's testing it right now, trying to break through. It doesn't know if it can. It's rejected it for the second time to get through there. If it closes below there, that's going to be bad news. It'll probably flush and come back down. See if it'll go up and close above it. But that's kind of the different ways you have to look at it. And then what you have to do is you have to sit around and you have to wait. Now, the biggest problem is you don't know when a market's going to take off and run like this. So what you do is you wait for it to take off and run like that first. And then you look for a little pullback, maybe 2 red bars, and then you look for the next leg up. That's your opportunity. So you get a little run like this, you get a couple little bars, and then you get to the drop down on the short position, right? Or you get a nice little run like this, you miss it, but you get a couple little bars like that, and then you get the next run. Pulls back, gives you a couple little bars, and then the next run. So you're always looking for the trend. The trend is your friend until it bends or ends, okay? And how does it end? Well, it gives a whole bunch of red bars going the other direction. Then the trend is down. And then it reverses like this, and you oftentimes miss it, like we just did, because this looked like, to us, looked like a downtrend. We have down, 2 little bars, red, looked like we might get 2 green bars and another big red. Well, it reversed. So we missed this one. So now what we'll look for is we'll look for a little pullback, maybe some red bars in here. How come my chart's just screwed up? I can't hold my mouse straight. Okay, so we look for the little red bars in here, and then maybe we'll get another opportunity to go up like that. Now you got a double top in here, and it's rejecting off of this previous high. It's trying to get in there. We got a couple closes above, so it's trying to go up past there. But now we might use that as support. So we'll have to wait and see. But overall, on a longer term basis, this is one big, let's put that right there. This could be one big long drive up, right? Drive 1, counter trend, drive 2. So if that's the way you look at it, it depends on the length of time you want to be in a market. So there's lots of different ways to skin the cat. And that's why there is a market, because everybody looks at it and trades it a little bit differently than the other guy. And so for every winner, there's a loser. And so that ought to give you a little bit of, a little bit of hope that, if somebody's losing, if you just took a small loss or something on a position, well, that means somebody else won. Next time, maybe it'll be you that took the trade and won. So as we come back in time and look, you can see we got longer trends. These are nice to catch. If you could catch something like that, you'd be making all kinds of money. So if you get in here on this one and you get out right there on that one, that's $1,345 with one contract, $1,700 investment from there to there. An hour and 26 minutes you'd have been in that one on this 2 minute chart. If you come down and look at it on a 1 minute chart, we come back and we look. See, it gets a little choppier. So that move in there, oh, come on, Land, you can't move your chart. There it is. So that move in there was a little choppier on a 1 minute chart. 2 minute chart, that was one move from arrow to arrow. But on a 1 minute chart, you'll notice that you get lots of little smaller moves in here. Little counter trend, little move, little counter trend, little move, little counter trend, a little move, little red counter trend, little move. See, and you could trade each one of those, or you could take a bigger risk at the beginning, because that's what it's really all about, right? You take a bigger risk at the beginning, the distance from where you get in to where you get out. So you get in here and you get out, let's say you get out 1 bar back, that, well, in this case on a on this market, NASDAQ 100 2-minute chart, that's $390. So it's a big risk. $390, a lot of money to me. You come down to the 1-minute chart from dot to dot. Well, that cuts that in half. It's only $115. $115 risk for entry. So you come down to this one, the micro mini on the 1 minute, and we come back. Let's do that same trend back here. That risk from exit to entry, $12. So it's all relative. It's just where are you at in your trading, and what level do you want to trade? How fast do you want to see the market? What risk are you willing to take? We go to the 2-minute chart on a micro, and then we go from entry to exit. That's about $15. So you're taking a $15 risk for a price potential profit. In this case, we follow the yellow dots all the way up. This is a 2-minute chart on the micro from entry to exit, from arrow to arrow. If you just go from arrow to arrow, that was $75. $75? Yeah, but it was only $170. $170 is the investment, and the risk for entry was $15. Right? So you put your position in. So as long as the market's moving and pumping and shaking, you can make money. The hard part is knowing when the market's going to move and pump and shake. So if you go back in time, you can see that market today has been pretty good, but we had some pretty lazy times today. Look how lazy the market was right through here. It doesn't look that bad, but I mean, you had some moves in there, but it had a lot of laziness in here before it took off and run. So there you get your laziness. Let's turn off that auto scale. We come in here, and so the market's going lazy right through here, and you're like, well, I'm not going to trade. The market's being lazy, right? Market's being lazy. Oh, lazy market. I'm just going to sit and watch. Oh, these are a little lazy in here. I don't really want to trade those. But then it takes off and goes like a rocket ship. Well, that's what you're waiting for. You're waiting for the market to take off and go like a rocket ship. And you're going to miss that first rocket ship. Well, oftentimes we call that the A1. All right. So I call this A1 because it's the first entry, right, on your A drive, on your first drive. So A1 is the first drive, and A1 means the first entry. So now this is still the A drive, but now we got right in here, we got an A2. So I always tell people, I say, don't chase the A1s, right? Don't chase the A1s. What do you mean don't chase the A1s? Well, that's every single little breakout that comes along. You jump into every single A1. And then every single little A1 fails. All right. So if you keep chasing every single breakout, every single little A1 on the first time a market looks like it's going to go, that's when you get your hiney handed to you. All right. So there's an A1, there's an A1, there's an A1. This A1 paid off, but you didn't know it was going to be the one that paid off. So you wait for A2. A2. Oh, those are nice. We like A2s. And then there's an A3. A3s are okay. Usually A3s are the short one and the A2s are the long ones, but then in this case, the A3 was the long one. All right. So you got that's the A drive. Now we come up here. If the market continues, we come down in here. This becomes a B1 right in here. This is a B drive, B1. All right. Every little takeoff right here. This is a B1. This is a B1, right? Every time it tries to take off, you get these little B1s. This B1, if you want to wait for the next B, wait for the B2. Okay. So now here's a B2. All right, I'm not taking B1s because they a lot of those fail. I'll take the B2. I'm more likely to make money, right? So then there's a B3. Okay, and the market's starting to slow down again, getting a little lazy, a little ugly out in here. On those, we don't like to trade above B3s. B4s get a little lazy. Now you see the market coming down. Now we're starting to go back up again. How do you know it's a B1, Len, or it's an A1? Well, we got a little bit of hindsight in there, so we can look back and see. Along the way, it's a little bit harder to tell, but you have the hindsight behind you, so then you start looking and you say, well, we come down here. This must be, we're going to call this C1. Oh, and we got another. You call this a C2, right? Call this a C3. It's pretty lazy up in there on those C's. But that's kind of the way you do it. You just kind of like, well, is it a good enough? The market's do it. Is it good enough for me to take a trade on? Do I want to give it a shot from this red to green? But just always for the upside, we're always looking from the red to the first green. See, that's your signal right there. There's your signal. Here's another one right here. See, there's a little false one. There's another one. Here's another little red to green, red to green. But if you take those reds to green and you try to associate them also with an arrow, they end up being a little bit better filter in there, right? So this is a downtrend. And then the market turned, went sideways, decided to go, it's just kind of wandering there. But it's just getting a little experience going back in time and looking at these markets and trying to decide when you want to get in. What's the A signals? The reversals are really hard. So if you're coming down and you're saying, oh, it's red, 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 I'm going to look for a big up green. Well, that's really hard. Okay, that's a hard one to catch. Now it happens, and that's what draws a lot of traders in and makes them lose money, because you're always looking for the reversal. And that's a hard way to trade. Always think of the trend. The trend is where there's lots of colors, lots of the same color. So that's a downtrend, that's red. So what we would look for is maybe 2 or 3 little green ones, 1, 2, 3 little green ones. And then the first red one, again, we would look for another short position off of that. If it doesn't go, then we miss this one too. We don't get it. And then so what we do is we say, well, there's a green one. Okay, green, 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 green. Oh, well, that looks like an uptrend. Okay. So we would look for a couple little red ones in the first green. And then we'd say, okay, we'll go with the first green after the couple of red ones. Doesn't happen. Okay, well, you're sitting on your hands. You're waiting, 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 waiting. Okay, so now, look, this is a little false signal here, but it comes down here. It's red, 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 red. We get a couple little greens. We get a red. Oh, we can take a short position. All right, well, you're going to lose. Then it goes red again, and then it goes green, green, and then it goes red again. You're like, I'll try it again, and then I'll try it again, and then I'll try it again, and then I'll try it again. And if you keep trying, try, that's where you get your hiney handed to. You got to realize that those bars are little tiny little things, and the market's dead, and there's no volume down here, and the market's just going sideways. You can't keep taking every single little trade just because it's a red to green. You got to also take into consideration the trend of the market, and there is no trend, so don't take those. Let them go by. Let them go by. Let them go by. But Lan, if I don't take every single one of them, the big ones right here go by, and I miss them. I know you're going to miss the first one. But that's okay, because you're going to take the next one. So if you wait for a nice, good trend, and then you get the red one, the next one, you're going to get the next leg. You're not going to catch every single move. You can't catch every single move. You got to wait until the market's moving in your favor. Wait for a nice move. Wait for a trend, and then take the continuation of the trend. Don't try and take a reversal. Reversals are really hard to trade. Now, we do a lot of reversals in this class because it's teaching you how to use the tools. And sometimes I just place orders to show you how to use the tool, not necessarily because it was a good opportunity to trade. So we need to also spend a lot of time learning how to trade, learning what to trade, not just how to trade. And mostly in this class, I teach how to trade, meaning how does the software work? How does the tool work? How does the setups work? How does the indicator work? How do the stop orders work? How do the limit orders work? How do intercept orders work? How do limit orders work? How do OCO works? How do OTO works? How does this one cancel that one? How does this one trigger that one? We do a lot of that kind of stuff because I'm teaching mostly the tools in here. And I try to teach you. I try to teach the lessons of the patterns that we're trying to teach. That comes along with it. But we don't sit around in this class waiting for the best patterns. And again, the reason we don't is because we might sit here for 3 hours waiting for a setup. So when you're really trading, you got specific times of day that you can go into, which traditionally are the best times of days to trade, right? So the morning session, and this student brought that up, says, well, Lane, I like to trade the morning session because you said it's the easiest to trade. Don't take my words out of context. The morning session has the biggest trends usually, which is what we want, but that doesn't necessarily mean it's the easiest to trade. It's oftentimes very difficult to trade because it moves really fast. And if you're not good at the tools and you're not very efficient at drawing, using your mouse and doing all the stuff you need to do to participate in those markets, and if you're not good at letting the computer take over and do it for you, it's not going to be the easiest part. It's going to be the hardest time to trade is in the morning because the market's all over the place and it's very active. It's going fast and you can lose $200 like that in a heartbeat. It's not the easiest to trade. It's just got the biggest trends and moves the farthest and makes nice trends in the morning. You go back and look at it in hindsight, And you look at it, oh, that's I can make it be rich, rich, rich beyond my wildest dreams. But then you go and try and participate in that, and you realize how difficult it is. That faster markets are not necessarily better markets for beginners and intermediate traders. The advanced traders are the ones that like to trade those really super fast markets that are going because they're good at getting in, getting out, and controlling their computers, and they have the automation and they know how to make it work. A lot of times people, and I mentioned this to the student last night too, when we were talking. I said the problem is a lot of people go and get this fancy software, this fancy track and trade software, which is like a Ferrari of the trading industry. I mean, it's a super high end version of a retail trading platform. Now, it's not a professional level platform. Goldman Sachs isn't using track and trade, but you're also not going to use the $35,000 a month subscription service to the software package that they use at Goldman Sachs. It's not logical. So this is a top end, one of the high end, top end retail trading platforms. But if you go get yourself a Ferrari and all you do is drive it to the grocery store to get milk, you're not taking advantage of everything that it's got, the capabilities that it has for you. You don't go out and get an F1 racer car that you race in the Formula 100 car and then just drive it to get milk. The software's got abilities that it can do things for you, and until you understand how to use those capabilities, you do things a little bit more slowly. Not that you can't trade if you don't understand all the tools in the software. You certainly can, but just realize that there's tools that can help you deal with those really fast markets. So until you understand the tools that can help you deal with those really fast markets, don't trade the really fast markets. Wait for the slower markets. Now, they might not move as fast. You might not make as much money as quickly, and the trends might not be as long. You have to be a little bit more on your toes in the beginning to make sure that you get your stops moved to break even, let the markets run. But you can trade a little bit slower market and still be okay. All right. And then if you're not ready to use some of the fancy tools, then that's okay. But I think that part of the idea of having this super high-end trading platform is that you use the tools that you bought. Right? That's why you spend the money to buy a high-end trading platform, is so that you can have special tools. It would be like buying a Tesla car and not getting the auto drive on it. Why in the hell would you ever buy a Tesla if you're not going to get the autopilot or the self-driving features? This is the whole point of having a Tesla, so you can have the auto drive features. Well, I want to drive my auto drive car manually. Okay, you can do that. But you know what? If you learn how to push the button that makes it go by itself, sure, a hell of a lot easier to drive. Same thing with track and trade. Track and trade is like a Tesla car. It's got capabilities to drive you anywhere you want to go all by yourself. You don't even have to touch the steering wheel. But if you don't know how to turn those buttons on, why'd you buy it? Go get some piece of shit that's free. I show you lots of pieces of shit that are free. You can just go use those. You don't need to use the Ferrari if you're not going to push the Ferrari button. All right. So that's the whole idea. Get you the good software, then learn how to use the good software. So we're going to come in here and we're going to see if we can get a trade off. We're going to start playing a little bit, but I wanted to do it in the micro today so you could kind of get an idea of the micro account. That's why, the whole idea is that when you're trading, you need to talk about your risk and money management strategies. And a lot of people get confused. What is risk and money management? They're like, well, that's where you put your stop and how much risk you take. Well, not exactly. That's just trading and that is your risk. But the risk management is not just for each individual trade. It's for your entire account combined. So your entire account combined, the risk management has to be from trade to trade to trade to trade. So I want you to think about 10 trades in a row as one risk management. All right. Does that make sense? Like, think of, okay, I'm going to trade 10 times. And out of that 10 times, how many times am I going to win? How many times am I going to lose? And then how much am I going to make? And how much am I going to lose over that 10-time period? We get so myopically focused on one trade that we forget that our strategy is good over a period of time, but it's not perfect. Just because you get a nice little green trend like this, come on, Lynn, click the buttons. Just because you get a nice little green trend like this and a perfect little setup with a little 2-bar red and another nice green and a little 2-bar red, another nice green and a little 2-bar, it doesn't mean you're going to be perfect at trading it. but you can get pretty good at trading it, right? And so these are both these are all B setups, all right? So this is an A, well, not really an A setup, but it's close to one. This is a B setup. This is a B setup. Why are these B setups? Not A1, B1, C1. That's different. But you're just going to tag the quality of your setups. What makes an A setup? What makes a B setup? What makes a C setup? All right. So you have to take that into consideration as well. So an A setup to me would be something like this that would maybe have an arrow. I would like to see a nice run in the market, a couple bar pullback, enough to break the arrows, and then an arrow to take you up to the next level. That would be an A setup. Why is this one a B setup? Well, because it's got the rally, the initial rally, right? It's also got the little red bars, and it's got the green bars starting up again, but it didn't break far enough to give you an arrow. Now it might give you a down arrow and then another up arrow, and that's what you would get. You'd a little flip flop like this. See how Doc Brown calls these a flip flop? Okay. Flip flops. So he likes flip flops. Why? Because it's a continuation of the trend in the same direction, and it's giving you enough of a pullback to give you an opportunity to get into the market. So this would be up and then a little ABCD pattern, and that's all we're really trading. ABCD patterns, right? A B C D, A B C D, A B C D, A B C D. ABCs can go up. ABCs can also go down. So you can go up and you can go down. A, B, C, D, A, B, C, D. And that's all we're trading. We're just looking for little ABCD patterns. Now, risk and money management would say you want to have the market go at least twice the distance of the risk. So if you're going to risk $10, you want the market to go $20 in your favor, right? But you don't know how far the market's going to go. So a lot of times that risk reward ratio, when people talk about it, is a bunch of bullshit, because you're going to take 4, 5, 6, 7, 8. You're going to go wherever you're going to take whatever the market will take. So my theory, the way I like to do it, is I want to take the least risk that I possibly can. So when the market gets into a situation where it starts to go, I want to take the least risk I possibly can. If I wait for a big long bar, if I wait to get in up here for a confirmation bar and I get up there and my stop's at that yellow dot, in this case, that's $26. Let's blow this up, make it bigger. And you're like, well, $26 isn't a big risk. No, it's not, but you're in the micro, so it is a big risk. It's $260 equal if you're over in the big one. So if we go over to the big one and do the same thing, okay, and we wait for the confirmation, let's clear all this out. So you come in here and you wait for the confirmation up here. Well, that's $175 risk, because you're going to get out at the yellow dot. But if you would have got in a little bit earlier, just when the market started to turn green, it's a $90 risk or even a $60 risk. Well, I could take $60 risk 2 or 3 times before I wait for, so I just like to try, and I know it's preempting and oftentimes it's better to wait for the arrow. But you're going to have to do what you want to do. You're going to have to decide how you want to trade it. Wait for the arrow. It depends on the setup on whether you want to wait for the arrow or not. Sometimes you get the green bar and it'll sit there and draw that green bar, and it's going to go up. It's the green bar. It's going, it's headed up after that. You want to get in early before you wait for the confirmation. It saves you an extra $60 or something on your risk. So there's different ways to trade different things, different patterns. It takes experience. So there's 3 drives. We're up the top of 3rd drive. Does that mean it's going to stop and go down? No, it doesn't. It's just that it's getting pretty hairy up here. The chances of it going up anymore are starting to get lower and lower and lower. So your opportunity costs are higher and higher and higher. So this is saying, okay, we flipped to the downside. We got 3 drives up. To me, I'm looking at this as an opportunity to possibly take a short position, looking for a reversal. Doesn't mean it's going to happen, but it's not my only trade, right? 1 out of 10 is all it is. And so I'm going to count all my trades combined as one trade, or as one risk management. This is getting a little spiky dikey do through the dot. So you're going to wait and see what happens. It's getting a little sideways now, a little quiet. But it's been trending. So let's see. We got some volume. The volume's starting to come down. Right? We're starting to lose our volume. Market started to go up. It's nice volume up. And then right in here, you can see the market started to go down, losing volume. Volume is the participants. How many people are trading contracts right now? You see the bars are getting smaller. You also see they're getting more whiskers, topping tails and bottoming tails. Claire calls them whiskers, right? We don't like topping tails and bottoming tails. We like flat tops and flat bottoms. If the market's going up, we want lots of flat bottoms. Market's going down, we want lots of flat tops. If we get little hairy tops on there, we don't like that. That shows indecision. But see, this is a smaller risk right here to take a short position here than it is if I wait. So if I get in there right now, I'm taking a smaller risk. Why? Because I'm going to put my stop at the yellow dot. If I waited, well, the market might go further away from my yellow dot. And then I have a bigger risk. So this is a smaller risk, but it's not a very good setup. But you take the smaller risk. And you're going to have 2 or 3 smaller risks than one bigger risk. They might just get stopped out again, but at least you took a shot at it, and it was a very small risk. And if it goes, then you look like a hero, right? Low-key PTV. Is that Paul? Paul Golden? It's nice to see you, Paul. Everybody remember Paul? He came and spoke with us one day. How's things going, Paul? We're talking a little bit about some of the more extraneous things of trading rather than just coming in here and banging at orders. Trying to talk a little bit of risk management today. So just how to read a chart, how to read a market, and how to get in there with the smallest amount of risk possible. Once your order gets to break even, you don't have to chase every little trend. You can start moving out to a longer time frame. So if this market will keep flushing here a little bit, I'll show you. We can move out to a 2-minute chart. This is a 1-minute chart right now, but we want to kind of stay right here until we get to break even. If it gives us the opportunity, if it moves far enough, then you can move over to a 2-minute chart, and then you're just playing with house money, and you're not holding your stop quite so close that you get stopped out just as the market takes off and runs again. So on a 2-minute chart, this would probably be all one trade from here to here. That would just be one trade. You wouldn't have this in there. See, we got stopped out. But we got stopped out with a tiny loss, $35. On a 2-minute chart, that'd be probably one trade from here to here. Whereas on the 1-minute chart, we got all these little breaks in here. So if you get in there on a 1-minute chart and then move out to a 2-minute chart, you're not going to have all the little breaks. See how that works? Then you can go up to a 5-minute, up to a 10-minute, up to a 15-minute chart. You can trade the longer term trends once you get in. So you can start on the 1-minute chart just to get your stop move to break even. And then once you got your stop move to break even, move out to the longer term charts and move to the longer term trends and stay in there for 2 or 3 hours, or stay in there all day if it'll let you. Make a lot of money. And you can still trail your stop. You're just trailing it on a longer term frame. The 2-minute up to the 5-minute, up to the 10-minute, up to the 15-minute. And you're still trailing your stops. You're just trailing it on a longer term time frame. And eventually it turns around and knocks you out, and you take your profits and away you go. And you have very little losses. You have 2 or 3 little losses like this trying to get in to the trend. See, we can sit here and we can take it again if you want. Jump in there, throw one in there. It's trying to break again. It's just being really stupid. So we'll put that in there, we'll edit that, and we'll just have a trail on the yellow dots again. If it goes, it goes. And you try this 3 times. If it doesn't work 3 times, 3 strikes, you're out. You're done. Walk away. So if you got 3 strikes and you're like, well, I can only take 3 strikes. I only have 3 trades, 3 attempts at getting into a market that I think it might go. And it doesn't go on those 3 strikes, and walk away, go away, get away from the market. Get up, go out, go outside, walk around, go ride your bike, go eat something. Try to eat something good and healthy so you don't end up like a fat trader. So go do something physical. Get away from your computer, and then maybe come back in an hour. If you want to trade some more, come back in an hour. Maybe the market will have made some adjustments and some dynamic changes for you, and you can trade again. But if you do your 3 strikes, you're out. You got to get away. And a lot of people, 3 strikes, you're out means they won't come back till the next day. Now, I'm not saying you don't have to come back the next day. If you lose if you're taking big risks, you lose a whole bunch of money. Oh, now I'm down 500, 600. I'm down $3,000 with my 3 strikes. You better walk away. You better not come back till tomorrow, right? But if you're just down, $50, $100, $75, $100, and you struck out 3 times, well, walk away and come back in an hour and see if the market's not doing a little bit better. It's all risk management and what you feel comfortable with and what your experience will tell you. I can show you how the tools work, and I can show you how all the indicators work, and I can show you all the little recurring price patterns. I can give you all my little sheets and my books and everything but what I can't give you is I just can't give you experience. That's something you're going to have to do on your own. And most of your experience, you're going to probably, have that experience come from the demo account, because you're going to spend most of your time in the demo account. The problem is, to get experience, you have to sit here and trade in the demo account. And so you're going to trade and trade and trade and trade in the demo account, and you're going to have lots of winners and lots of losers, and you're not going to really practice your risk and money management. And that's the point I'm trying to make. When you start getting to the point where you think you're ready to go real money, then you need to trade in the demo account the way you're going to trade in the real money account, where you're going to sit on your hands for 3 hours, even in the demo account. And you're going to wait for a perfect setup. You're going to wait for that A+ setup. What's an A+ setup? An A+ setup is where you're going to get a nice big set of bars. All right. You're going to get a nice trend. Market's moving. It's making nice flat bottoms, lots of flat bottoms. And you're going to get a couple of little bars in there, red bars. And then you're going to get another set of big trends. But you don't know that big set of trend is coming, because you're going to get in right there in anticipation of a continuation of the trend. All right. That's your little hesitation. Now that in the industry, we call that a pennant formation. All right. So you're going to trade pennant formations. And that's your A setup. And in the beginning, that should be the only thing you trade. Are there lots of other setups? There are lots of other setups. Okay. But for you as a beginner, that should be the only setup that you trade. Red to green. That's the only thing you're going to do. And you're going to wait for a nice big long set of greens. You're going to look for little reds, and then you're going to trade the next long set of greens. And that's going to help you get your, and you don't want to trade like we're doing now, right? This is not good. Why? There's not a lot of flat bottoms. The market's not trending. There's not a lot of flat bottoms, flat tops. There's lots of scary, hairy, it's hairy bars in there. You don't want hairy bars. Remember that word, scary, hairy. All right. If it's hairy, it's scary. If it's hairy, it's scary. Claire calls them whiskers. All right. If they got whiskers, you don't want them. All right. She hates to kiss men that have whiskers. If you're a girl, maybe you remember that one better. All right. Now, for me, I'm telling you, now here's a little thing that you're going to have a low risk right here. The dot is just barely above it, and it looks like it's trying to fall. So you're going to take a very little tiny risk. See that? Now, is this an A setup? Hell no, it's not an A setup, but it's a very tiny risk. So even on your A setups, you kind of want to have a tiny risk. You don't want to take big risks. If you have what looks like an A setup, but your risk is going to be like $200, don't take it. It's not a good enough risk versus reward ratio. That's what we call that, right? A risk versus reward ratio. And you're like, well, I don't know how far the market, what's the risk reward ratio? Well, risk reward ratio is just something that you're going to have to figure out how much you're willing to risk to get into the market. How much, I had a buddy that I used to trade with, and he would say all the time, he would say, how much are you willing to spend to find out if you're right? How much are you willing to spend to find out if you're right? That's your risk reward ratio. That's your risk ratio. How much are you willing to spend to find out if you're right? Well, how confident are you that the market's going to do what you think it's going to do? Okay, we're breaking the yellow dots right here. This has been a counter trend. Counter trends are usually got lots of whiskers, right? And then the trends themselves have less whiskers. So we got a nice uptrend. We got the little counter trend. Now we might get another uptrend. So this is coming in right now, the yellow dot. As soon as that yellow dot flips, we get to the other side. That's going to give us an arrow. Now, if you want to preempt it and say, well, I don't want to wait for that dot. It could be way up here before the dot comes. You could get in earlier, which is what I was trying to tell you earlier, right? Get in, you could preempt that, and then your risk is going to be smaller. Now we're going to come in here and we're going to do the same thing. We're going to come in and go trail on the ATR. Now we had 3 losses, 65, 45, 35, but they were all tiny little losses. Tiny losses. That's $145, Lan. That's too much. I can't afford that. Well, then you're trading the wrong market, right? If that scares you, $145 to have 3 losses, those are tiny losses. They're really good on keeping those losses small. Now, the problem was that we were trading shitty setups, right? So, but nonetheless, those were very small losses. So if that's too much money for you, you should be in the micros, not in the minis. The thing about that is when we catch one and it goes, it'll pay $145 off in one bar, right? One price bar, two price bars can pay off $145. See, right now we're already up 130 right now. Okay, and then if we can catch a trend and this thing goes, now you can take it off and just get your money back. We like to do that sometimes, right? So we get rid of this stop, we'll just get rid of it, we'll close it out, and we'll take this order and we say add OCO. This is one of those neat little tricks, right? We can turn this back on, edit. We're going to come in, we're going to say, we're going to trail that on the ATR. This is part of that Ferrari setup, right? And then we're going to have this one out here. We can set it up and take our profits. So right now that's 290. We're down 145. If you wanted to just take your profits off, there you go. You're up 145 bucks. Now you were down $145 just 2 minutes ago. Now you're up $145. All right. So that's how you do it. Now, if you want to let it run farther, you can. I just took it off because I wanted to get out of the hole. Now I'm green. Now I can operate from a point of strength instead of from a point of weakness. So if I'm down red, I like to get my money back and then wait for another setup and sit here for an hour and wait and see if another good setup comes in. Then I can work from a point of strength instead of from a point of weakness. So once you have a point of strength, you don't have to you don't have a point where you're like, well, I got to get my money back. If we were already up $100 right here, we wouldn't have taken that off. Why would we have taken it off? We weren't trying to recover losses. So a lot of trading is just recovering losses. And you have to kind of realize that, a lot of guys will tell you, don't pay attention to how much you've lost, just trade the trend. I've learned, and for me, that's bad. I don't play that game because I'm too emotional. All right. Maybe you got better control over your emotions, but to me, I get very emotional when I get trading and I realize I have to get my money back first. That's what my goal is. So I can get back to a point of strength and then I can start trading once again. But if I start building myself a big, deep hole and I had the opportunity to get the money back, how many times have you been trading and you were down $200, $300, and then you got into a trade and you got all your $200, $300 back and you're like, well, I'm going to stay in and get more. And then you end up back being a loser again and didn't get all your money back. You had it. It was there. They gave it. The market was being nice to you. It gave you your money back, but you were too greedy and you wanted to take more than what the market was offering you at the point. So you stayed in and then you end up losing more money. Now there's times where you'll stay in and you'll make more money. And yes, that's true. But for me, I don't want to be in that situation. I just don't like to be down. So I want to bring myself back to green and then I can start waiting for another setup, looking for an A setup. I'm willing to trade B setups. I'm willing to sometimes even trade C setups. But in the beginning, when you're trading, I don't think you should. I think you should just trade A setups. Just wait for the market to make a nice trend, lots of flat bars, a little red, and then wait for that market to start going with green again, and then get in on that one and have a very small risk. And if it doesn't immediately go in your favor, just get out. And just sit on your hands and wait again. There's so much money to be made in these markets. You don't have to catch every single one. You're never going to catch every single one. You can't. It's impossible. All right. You're lucky if you can just catch a couple of good ones each day. And that's the name of the game. Just catch a couple of good ones each day and you can do bang up job. But you have to be really careful and you have to have a lot of patience and let the computer help you. Don't just think you can do it manually. Let the computer help you. That's why we got these massive, fancy tools for you. Don't buy a Tesla and then just drive it around yourself. It's got to spend hundreds of millions of dollars to make it drive by itself. Why would you get a Tesla if you're not going to let it drive by itself? All right. So right now we can just kind of sit on our hands and say we got 5 minutes till the market's going to close. And we wait for another setup. Now that bar right there, see, that's a crazy indecision bar. Topping tail, bottoming tail, big topping tail, big bottoming tail, knocking out everybody's stops. All right. So that's what that was doing. There's orders above and there was orders below. And it got both sides. It went up and stabby dabby dude right there. And it went down and it stabby dabby dude right there. So it wiped out everybody on both sides of the trade. So now what it's doing is once that happens, these are all new trades coming in. All right. Everything after that spiky dikey do bar. And if you go look in the manual, there's a whole section that we talk about on that one bar right there. So now this is a whole new trend starting. These are all new traders because they all got knocked out. All the traders got knocked out here. They all got knocked out here. And now it's like, okay, which direction are we going to go after everybody gets knocked out? They want to go bullish. So they started buying back in again. So wait and see what it does. Why aren't you trading land? Get in there. Get in there. Fight, fight, win. That's not how you trade. You wait. Mostly you miss most trades. I mean, after the fact, you're like, oh, gee, I could have got that one. Oh, I could have got that one. Oh, I could have got that one, but I just sat on my hands. Nothing wrong with that. There's nothing wrong with that. Now, in this class, if I'm not constantly banging at the keyboard and banging at the orders and trade, people leave, right? This is YouTube. People have short expansion span. What am I talking? What's that word I'm looking for? Attention spans. People have short attention spans. So they come in, they click on and they go, oh, he's not trading. He's just looking at the market. They go somewhere else. They're not here to learn. They're here for, financial entertainment. They want to be entertained. And we do a lot of that on this account. We like to come in and trade and see what the fancy Tesla tools will do. See what the self-trading tools will do and see what we can make the software do. We do a lot of that. But a lot of it, you should just, you need to be sitting on your hands. So for example, here's an example. I'll show you one right here. We can come in here. We'll just do a manual and I won't use any of all these fancy ones, but you can come in here and you can set your stop up and you can say, okay, edit, and you can just make it trail on the ATR. We'll just make it trail on the ATR on the little yellow dot. And that it's an open order and it'll sit there and trail up there by itself. It's kind of like putting it on autopilot and it'll turn around and it'll come back down through there. And if it starts to flush, it'll hit my order and take me short. Now you can do the same thing to the long side. If you're not real comfortable taking short positions, just trade to the long side. But this is for a reversal. Now you don't have to have just one. You can come back here and you can say, I'm gonna put a stop order down here and I'm going to go like this. I'm going to edit and I can say I'm going to trail price bars back and I'm going to go 2 price bars back like that. Now I got a different location. I got 2 trailing stops for entry. It'll pick up one and then it'll pick up the other one. Now it doesn't count the action bar. The action bar is 0 and then 1 price bar back is the price, the first close bar, 2 price bars back is the second close bar. Now the dots are in a different location. Now you could come in here and you could go like this. And we could turn on another set of dots. How about parabolic SAR? And we can come in here and we can say, okay, I'm going to also trail, edit. And I'm going to trail on parabolic SAR right there. Now I got 3 trailing orders for a short position. One will get me in right at the yellow dots, which is really close. I got one that's trailing 2 price bars back, and I got one that's trailing at the parabolic SAR. So if those 2 get me in, I got one more down there that'll get me in again at a little bit further down, add to my position. There's just all kinds of things you can do with the fancy software. Almost anything you can imagine you can do because it's designed to be that type of a trading platform. All right. Now we want to put our stop in there, and usually we want to go 1 price bar back. And if it stops us out, well, we take a very small loss. If it doesn't immediately go in our favor, we just get out. And if it's making lower highs, we got in because it's making lower highs. Well, if it turns around and starts making higher highs again, it's no longer in a downtrend, breaks that higher high, we just get out. Now, sure, it could just get us out, spiky dikes do us and flush, which it does. But I'm of the opinion if it doesn't immediately go in your favor, just get out. This is just sitting there. We're going to go now. We're going to change this. We're going to go, let's get our, oh, there's the market just closed. So the market's closed. we're going to probably, you can sit here and let it go in the after hours. Now in the futures market, the after hours the rules don't change. You don't have to go to just strictly limit orders. So you don't have to worry about that. I'm going to take this off because I don't want to add one on right here. All right. Let's just take that money off. So, okay, well, we ended up $390 up and just goofing off here in the last hour. All right. Just goofing off, up $390. Now you have to take your commissions and fees out of that, but commissions and fees on the micro, on the mini, almost insignificant compared to the micro. Or micro, the commissions are going to be a lot higher. That would have been $39 in the micro for the same trades, right? As opposed to over here, it's $390. All right, guys, I've lectured long enough. Kept you here. The one thing I want to do is show you the software I'm using so you can know. So you're like, Land keeps talking about that really cool software. I wonder what it is.
Okay, this is the software I use. It's called Track and Trade. They've got two versions. One for stocks, one for futures. This is the website. Track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here. Follow along, and I'll show you all my settings.
All right. So next time we're going to meet is tomorrow morning. And tomorrow morning we're going to be using the stocks version. We're going to be looking in the morning session. We're going to be at 8 o'clock in the morning. So be here at 8 o'clock in the morning, and we'll have the stocks version up, the software, and we're going to be talking about our UBI, Universal Basic Income Portfolio. I'm going to show you my actual money, real money portfolio, trading portfolio. We're going to go in and analyze the markets and charts and see what markets. I got a whole bunch of money that just came in, made a whole bunch of cash sitting in my cash account from the yield, from the dividends that came in, and I need to invest that back into the market somewhere, or I need to take it out and buy me a Tesla. Whatever I want to do with it, I can take that money out, I can go spend it, or I can put it back in. I don't need it, so I'm going to go put it back in. All right. So if you want to come and see what we're going to do with that tomorrow, see what I'm going to do. In my YouTube classes, I don't tell you what to do. I just tell you what I do, and then you can try to learn from my experience. I've been doing this for 30 years, and if you want to learn from my experience, great. Or get your own experience. That's, the best way to learn is to talk to somebody who's done it. And so tomorrow morning, we're going to look at my portfolio. It's broke over. It's over $1 million. It'll be $1 million portfolio. And we got a bunch of money coming in. We need to reinvest. And I'll show you how we're going to do that tomorrow. All right. 8 o'clock in the morning, we're going to do that. And then we only teach Mondays. Right now we're on Tuesdays in the morning at 8 o'clock. Wednesdays is this class, so at 1 o'clock in the afternoon, and then Thursdays in the morning, and then we don't teach Mondays and Fridays. We take those off. Now next week we're going to have the same schedule. We'll do the Tuesday, Wednesday, Thursday schedule, but after that we're going to be back down in St. George at the university, because I teach at the university. So we're going to classes start. So for those of you who are going to be in my classes, great! I can't wait to see you in person. And we'll learn all this great fun stuff in person. I always like to meet with people in person. And then we'll change the schedule. We'll probably go a little bit heavier, but we'll probably go back to the everyday, because I have to do the labs for the classes at the university. But the classes don't teach every day. So we'll see. We'll change the schedule up when we start doing the university classes, because these are the labs for the university. And we're off for the summer, but summer's over and classes start up again in 2 weeks. So we'll be back to class. All right, guys, we'll let you go and we will see you again. Oh, and I got one more thing for you. Don't run off, because if you don't have Pit News Magazine, I don't know what you're doing with your life. You got to have Pit News Magazine.
Look, folks, I was reading this thing. Pit News, great stuff. Back in Scranton, we had newspapers. We didn't have, the thing with the facts. Claire Christensen, she gets it. She gets sharp. Sharp. Reminds me of my Aunt Margie. Could parallel park a Buick with one hand. Subscribe.
We would never use AI to get celebrity endorsements.
Look, if you haven't subscribed to Pit News Magazine yet, then I'm going to need to see you professionally, because you must have something wrong with your brain.
That's exactly right. So go over to Pit News Magazine and subscribe, because it's where we document all the stuff that we do in these labs. It's a nice little fun magazine, comes out once a month, and has all kinds of great articles about trading.
Hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pit News Magazine. You can thank me later.
All right, guys, that's it. That's all I got for you today. We'll see you tomorrow morning, bright and early, 8 a.m. Bring your portfolios, your UBI portfolios, and we'll analyze the markets and see where we put our money.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.